Thank you very much, ladies and gentlemen. Today we are conducting the webinar on the financial consumer protection. Dear ladies and gentlemen, from the Cambodia. Let us start now. Ladies and gentlemen, the Cambodian financial industry has been endeavoring to raise the country's responsible finance standards in recent years. That is in line with the international and Asia regional trends for strengthening the conduct performance of financial institutions and for enhancing the regulatory supervision on financial consumer protection in recent years. In this context, and under the framework of IFC intervention focusing on strengthening financial consumer protection mechanism in Cambodia, the Association of Banks in Cambodia and IFC join hands to organize a series of the webinars on the financial consumer protection topics over the next few years. These activities will help to raise the awareness of the financial industry workers in Cambodia and to promote a common and professional understanding of the various FCP subjects, as well as the relevant requirements of national and international standards. Today, first webinar will be focused on understanding and mitigating the conduct risks. The participants of the webinar, we would like to introduce from the Bank Association, Miss Kwajin Abdullah, Vice Chairwoman of Association of Banks in Cambodia, the Chief Operating Officer of Maybank Cambodia, Mr. Heng Koi, General Manager of ABC. From IFC, I would like to introduce Mr. Zing Chang Lai, the Principal Operation Officer, the Head of the Financial Infrastructure Practice Group from the Financial Institution Advisory Service, Asia and Pacific. And from the Cambodia Microfinance Association, I would like... So from the Cambodia Microfinance Association, I would like to introduce Madam Nita, the chairwoman of the Cambodian Microfinance Association. So attendees from the attendee of our webinar today, I would like to welcome all the representatives from National Bank of Cambodia, from the financial institutions and international development agencies. So today we're going to have the our main speaker, who is Mr. James Carroll, a veteran conduct regulator from Canada. And Mr. Carroll will present on the typical conduct risks faced by retail and microfinance institutions and how to mitigate those risks and the expectation of the international standards. To start the webinar, I would like to invite Ms. Kwajin Abdullah, the Vice Chairwoman of the ABC, to deliver the opening remarks. The floor is yours, Ms. Kwajin. Thank you. Hello, Ms. Kwajin? Ms. Kwajin Abdullah, are you here?
So, Mongkoi, Miss Karin is online, right?
I did see in already, so let me check.
Yeah.
The issue with the connection. She tried to log in.
Okay. So, ladies and gentlemen, could please wait for a moment, and then Ms. Kwajin can be connected. Well, while we are waiting for Ms. Kwon Jin to be connected, so Suki invite Mr. Jing Chang Lai, the representative from IFC, to say a few words first.
Yeah, I think yes, please do that. Thank you very much.
Yes, yes. Okay. While we're waiting for Ms. Kwon Jin to be connected, may I invite Mr. Jing Chang Lai, the Principal of Operation Officer of IFC, to open the webinar. So Jing Chang Lai, the floor is yours.
Okay, thank you, Huyen. And good morning to everyone. Thank you for your participation. And we are very pleased to organize this webinar together with the Banking Association of Cambodia. So thank you, Ms. Vice Chair of the association and Mr. Han Kuai of ABC. We plan to do a series of such knowledge event on the subject of financial consumer protection, or FCP, over the next few years. Today's webinar is the first one on this series, and it will be an overview of conduct risk management for financial institutions, and it will be delivered by Mr. James Kalon, and some of you already know him. He's the former head of Canada's bankruptcy agency and also the former head of Canada's Financial Consumer Protection Agency. So why are we doing this? As you know, FCP is a challenging area in Cambodia. It has attracted international attention in recent years. There are certainly more work that needs to be done by financial regulators, industry associations, financial institutions, and civil society. Among others, it will be good to raise the understanding and skills of the financial services workers in this area over the next several years. This is because FCP concerns every employee of a formal financial institution. It is not just a matter for management and compliance staff to worry about. It is a matter for everyone in the industry. Thank you again for joining. Without further ado, I will pass back the floor to the host, and we will have some time for questions and answers towards the end. Thank you, and have a good webinar.
Thank you, Mr. Jing Chang Lai. I hope that now Ms. Kwon Jin is connected. So the host, could you please help me to check if Ms. Kwon Jin is there? Hello?
I think she's still problem with the connection.
Okay.
I think I would request to proceed.
Yes. Okay, so thank you very much. So I think that why Ms. Kwon Jin is difficult to connect to our webinar. So maybe we will leave the time for her speech later on. Before we going to the content of the webinar, may I request all the participants to open your camera to take a picture. Thank you. And all the participants, could you please turn on your camera? So all participants, could you please help me to turn on the camera? Hello?
Yes, yes, here we see participant turning on cameras, and the ABC team will take a photos before we going forward. So Udom, ABC team, let us know when you are done with the photo.
Yeah. Thank you. Thank you, AB team. Could you please take a photo and then when you finish, please let me know. Thanks.
I see Abby also there. Hi, good morning, Abby. Thank you for joining.
Hello, Abby. Thank you for joining us as well. I just saw you.
Dom, lên screen hai nữ Dom.
Hoi, can you hear me?
Oh yeah, yeah, we can hear you.
Oh, okay. So sorry. Has it started? I'm so sorry. The issues with
Okay,
the
now connected.
technical.
We can hear you.
Okay.
Okay, cool.
Okay. Thank you. Thank you, Miss Kajin. So now we are connected to our webinar. May I take some few minutes to invite you to deliver some speech? So
Okay, sure. All
Thank
right.
you.
Thank you so much. Thank you.
very much.
Sorry for the delay. Yeah. So good morning. Yeah. Distinguished guests, esteemed speaker, colleagues from the IFC, fellow bankers, of course, ladies and gentlemen. So welcome to this first series of the webinar on financial consumer protection, understanding and mitigating conduct risk, co-organized by the IFC and the Association of Banks in Cambodia. Now, today's webinar is crucial. Yeah, it will equip all of us, with the tools to strengthen consumer protection and foster a more trusted financial services industry. The Association of Banks in Cambodia has considered consumer protection and consumer empowerment as our core prioritized agenda to contribute to the National Financial Inclusion Strategy 2019-2025 by fostering responsible banking practices, which mitigates reputational risk for both individual institutions and the entire sector. So now, with rising uncertainty, proactive risk mitigation is essential to build resilience for our institutions and the banking sector as a whole. So to that end, this webinar series on consumer protection equips bankers with latest strategies to stay ahead of potential risk. So on behalf of the ABC Financial Inclusion Committee, I'd like to express sincere gratitude to all of you for attending this morning session. Special thanks goes to our partner, IFC, for your invaluable support in making this webinar possible. We look forward to your continued collaboration on such important initiatives. Finally, I'd like to express our deepest appreciation to our speaker, James, for generously sharing your knowledge and expertise with our fellow bankers today. So thank you once again for attending this morning's webinar. I hope the discussion will be fruitful and productive. Thank you.
Thank you. Yeah, thank you.
Thank you. Thank you very much, Ms. Kajin. So now I think that the ABC have finished to take the photo of our webinar already. So to go to the real contents of the webinar, may I introduce Mr. James Cullen, who is our main speaker for today's webinar. So the James Cullen will deliver the speech during the next 2 hours, and then we will also have the time for Q&A, for question and answer as well. So now the floor is your Mr. James Cullen.
Thank you, Wen. I want to thank the Association of Banks in Cambodia for the invitation and the opportunity to present to Cambodian financial institutions a regulator's perspective on what it means to monitor and regulate conduct in retail financial institutions. Most of my career and consulting work has been in dealing with conduct and compliance by a range of regulated entities. Entities whose conduct were regulated under employment laws, entities like creditors, trustees, and debtors whose conduct was under the insolvency and bankruptcy laws, and of course, the conduct of financial institutions under financial consumer sector laws. So I've spent a career dealing with conduct and the need to ensure that there's compliance with conduct rules. Working with IFC since 2015, we focused our efforts on developing a set of principles and standards that could provide a framework for the supervision of conduct of financial institutions. And during these same years, I note that the Association for Microfinancing and for Banking have also made positive efforts to establish a set of voluntary standards, codes of conduct for their members. And from a regulator's point of view, from my point of view, such industry collaboration and participation is clearly an essential component of protecting consumers. Regulators cannot deal with conduct risk alone. Efforts for self-regulation from a regulator's perspective, you'll hear that a lot the next hour or so, must be combined with independent and effective regulatory monitoring, inspections, and enforcement. And that way we will ensure that we can raise the bar equally among all financial institutions. For this morning, I welcome a diverse audience. I think we're over 100 participants from financial institutions. I certainly appreciate so much interest in trying to understand what the importance of good conduct in financial institutions means. So this morning, I want you to consider that the presentation is based on a regulator's experience in dealing with a multitude of entities in terms of ensuring that there's a proper conduct and that the risks that conduct creates have been mitigated either by the entities themselves or through regulation. So let's start with the presentation itself. So let's start by having an understanding of what we hope to accomplish over the next hour and a half. One is to make sure we all get a common understanding as what we mean by conduct. What do we mean by conduct risks? And what do we mean by standards of conduct, often referred to as consumer protection standards? So we'll also review what are some of the expected standards of conduct or principles of conduct that already exist in Cambodia. And we'll take a look at how that's applied internationally with some examples. We want to increase through a webinar like this to increase the level of awareness and understanding by providing a regulator's view of what conduct in financial institutions means. What are the potential risks for consumers when there's conduct risks that are generated by financial institutions? And we know that from past crises in the past, based on conduct, the financial crisis of 2007, 2008, was primarily misconduct, that it can create havoc and financial loss for consumers. It can disrupt the marketplace, and it can erode the confidence in the country's financial system, all of which we've experienced in the past years. So let's also, in this presentation, provide an international scan of past conduct risks that have created significant problems within countries. And we'll examine what are some of the potential sources of conduct risks. What are the root causes of risks that we've encountered in terms of financial institutions? So the agenda for today is as such. I'll briefly explain what we hope to talk about. First, we'll talk about what are the current expectations of good conduct of financial institutions in Cambodia. We'll take a look at ensuring that we are using the same definition of what a conduct means, what risks means, what do standards mean as we go through the presentation. We'll look at the scope of conduct risks. In other words, what's the areas that regulators are going to consider in terms of their regulatory monitoring and supervision. We'll look at the examples of the international misconduct and the costs incurred. We'll look at the sources of conduct risks. In other words, what may initiate financial institutions to create conduct risks. We'll then provide a fairly good sample of what we typically see in terms of retail conduct risks that are evident in Cambodia, but typically in most financial sectors in other countries. We'll take a look at what's referred to as systemic risks as financial sectors get more complex, as the products get more complex, as there's more interrelationship between financial institutions and between countries. The possibility of a single conduct event spreading across multiple institutions or across countries is a significant concern in dealing with establishing a framework that meets the standards either through the IFC standards of what we think should be in place as a framework, or through the OECD, which has also a set of standards that it recommends for regulators to adopt. We'll take a look at the operations of financial institutions and different departments, and where are some of the conduct risks that I found, and where and why were they generated within the financial institutions. Finally, we'll take a look again at what I've observed in terms of conduct risks, both when we were here in 2015 and more recently when we were there just last year. And then we'll have a concluding comments on the presentation and on the concepts of mitigating conduct risks. So that's what we hope to accomplish. I'll try and provide as many examples as I can to go through it to clarify what the intent is. In terms of the PowerPoint, I've provided a significant amount of detail. It's not my intent to read them. But as I go through the topics of each slide, I will refer to certain parts of the text. But I provide the detail for you as a reference tool. After the seminar, you'll have a good reference in terms of the topics that we are going to deal with this morning. So let's take a look at expectations of good conduct. So I took a look at existing financial sector laws and regulations in Cambodia, and took a look at when it talked about conduct, in other words, behavior. So if we look at, you'll see the PRACA numbers that I've put on the slides. In this PRACA, BC 0004, it talks about the appointment of managers and the need to assess their good reputation, their fairness, and their worthiness of the person concerned. If we look at the law in banking and financial institutions, it also has concepts of what it wants in terms of conduct. It wants transparency, it wants openness, it wants the regulator to develop a corpus of good conduct aimed at ensuring consumer protection, customer protection. If we go on to the next, another PRACA dealing with requirements for applying for licenses. What is the regulator expecting? If it's going to provide an entity a license, what is the balance it seeks? It seeks honesty, integrity, a reputation of fairness, and strengthened by a entity that can provide competency and capacity and financial soundness. I'll go on to the practice on governance. In there, you'll see significant standards relating to conduct, the B010-172, the dealing with setting up controls. It also sets out standards of conduct and the effectiveness of internal controls. So what I intend to say with those two slides is you already have requirements in terms of the behavior of financial institutions in your laws and your regulations. And you, as employees of financial institutions, you may want to consider how would you measure whether your financial institution is in compliance with those conduct requirements. And if you can't explain how you could justify that you have a system that has integrity, honesty, it operates with fairness, then you're open to potential there's going to be conduct risks. You need to be able to understand not only what the conduct expectations are, but how are you going about mitigating that those good qualities are actually implemented within your financial institution. When you're applying for a license, there's a condition there. The entity is applying because it wants to provide financial services, and clearly the intent is to make a profit. If it granted the license, then the other side of the equation is the regulator, and the government itself is then expecting that entity to respect the level of conduct that it sets out in its laws and its regulations. a basic requirement on the licensing is that you accept that you will implement these types of conduct within your institutions. So then let's go on. This summarizes what I've just talked about. What are the expectations in Cambodia based on NBC, based on the financial sector law? Expecting honesty, we're expecting transparency. It talks about openness. I translate that to mean disclosure. It demands fairness, it demands integrity, it expects a good reputation, it expects compliance, expects competency, and expects knowledge. So there you have the framework in general in terms of what is the expectations regarding the conduct by financial institutions in Cambodia. So then let's look at the international side. The international side has very much similar types of conduct. I thought what I would do with this slide is actually look at the international standards that go to support conduct. So the standards that are quite rigorous are to ensure there's effective governance, accountability, and conduct risk management controls in place. There's regulations in terms of ensuring there's third-party dispute resolution and redress. Because if you look at the conduct, it's fairness. It looks at product design, distribution, suitability. It looks at issues of deceptive marketing, advertising, solicitation, what's considered negative option selling, specific disclosure and transparency requirements by type of product, by type of service. Someone mentioned earlier the focus on responsible lending has been a key component in terms of international standards since the financial crisis of 2007, 2008. The issue of debt counseling, debt collections, and the compassionate need to deal with consumers in distress. And finally, the focus on ensuring personal data security, privacy, making sure unauthorized use of consumer information has strict controls. So in section 1, we talked about what's in place for Cambodia. We've also talked about on the international side, where have they focused in terms of specific standards to reinforce those conducts. So let's go to some definitions so that when we leave this seminar, you'll understand what we mean by these words. Conduct simply means the manner of behavior and associated actions taken by a person or entity or an organization. In other words, how do they act and how they carry out their decisions or their actions. Risk simply means that there's a chance of failure, there's a chance of creating harm, there's a chance of causing loss, or there's a chance of not meeting an expectation, an obligation, or a commitment. When we refer to standards, we're talking about specifically a minimum standard of conduct expected that is targeted of financial institutions. So when we put the words together, conduct risks refer to the types of conduct, activities, and actions taken by financial institutions that may cause harm, loss, or failure to meet expectations and obligations. It's a pretty broad definition, but that's what the regulators focus on in terms of conduct risks. So let's look at the scope. When I mentioned in the agenda, scope means what are the areas regulators will start looking for in terms of potential for conduct risks. We'll look at the behavior, the actual behavior, the activities and actions that are involved in managing the financial institutions. It will include its conduct in terms of how it handles its prudential matters, but also its conduct in terms of how it behaves in the marketplace and how it deals with consumers. So the scope of monitoring can be as broad as looking at the choice of the business lines. When the financial institution comes in with an application for a license, we're going to want to look at what is the business about? How complex is the business? Is it decentralized? Is there going to be a resource capacity issue? Does it have the expertise required to operating the business? Is it going to be into outsourcing or insourcing of services? We will analyze exactly what your business plan will be. We'll take a look in terms of, do we see the risks in terms of what is being proposed in terms of the business? If it's a financial institution that's a simple savings account with no complex issues of lending or investments, of course, the risk for conduct is minimal. The more you add to a business line in terms of its products and services, the more complex you make the organization, the more decentralized you make it, the more chances that there will be a failure, that there will be a risk created in terms of how the business is operated. So that when an entity comes in, we want to take a look at that. If the business changes, it decides in response to the marketplace or in response to consumer trends that it has to change its business lines or add to it, we'll want to go through the same analysis. What will that new business line do in terms of risks, new risks, but will that change in business line alter what may have been another business line previously done? So we'll take a holistic approach in terms of how the business evolves over time. We'll want to look at the culture of the organization, the culture of management. Is the culture that we monitor, do we see signs of recklessness? Do we see signs of carelessness? Do we see signs of abusiveness? Do we see signs of irresponsible behavior, whether it be from the shareholders, the board of directors, management, personnel, operations, administration, legal, third-party contracts? We want to get a handle in terms of how do those players in the organization behave. You may have a board of directors that feel it's operating in a fair and responsible manner, but on the other hand, you have irresponsible management that has its own agenda in terms of how it wants the operations to go. You have staff operating at the front end. Maybe they develop a culture in terms of how they treat the customers. You have a culture perhaps by third-party contractors that feel that if the financial institution isn't paying attention, they can get away with doing misconduct in terms of its treatment of consumers. We want to look at the business practices and how sound are they? What are the conditions that are in place to ensure that when you introduce a new product, that the design of it, the marketing of it, the sales of it, the level of transparency, the level of disclosure, the need to deal with any dispute resolution once the product is launched, that all the practice, all the policies and procedures that go into the design, the marketing, the sales make sense, that there's checks, that there's quality control. So when the product actually hits the marketplace, there shouldn't be a risk to the consumer who decides to acquire the product. A sign in terms of the culture can be in terms of how does the organization compensate its management, how does it compensate its staff? It's pretty well founded among conduct regulators that if you see a financial institution with a compensation system that's simply based on sales performance, that you are going to have risks to consumers. You're going to have misconduct in an effort to make quotas. In order to meet quotas, they will meet their whatever the salary limits are. That is a main warning light for regulators. If we see that financial institutions simply are or predominantly using financial compensation for staff. What we want to see is that there's rewards for staff or management for good performance in terms of service to the consumer, in terms of dealing fairness with the consumer. Another component in terms of the culture is how responsible are they in terms of controls? how appropriate are the risk management practices in place? You can ask yourselves now, if you're coming from financial institutions, you have been informed of the types of conduct that the regulator, NBC, expects of the regulators. From your perspective, is your financial institution actually looking at the risks posed by each of those conducts, those expected conducts? So that gives you two key scopes or areas of supervision. There's more. We look at the conduct itself. So we want to look at the manner and treatment of consumers. So that's why we want to know, we want you to keep data on terms of your treatment of consumers, the complaints, the type of complaints, the issues with products and services. We want to see whether the financial institution has a record of dealing with or actually identifying and dealing with conflicts of interest. If you have a compensation scheme based on financial rewards, you immediately have a conflict of interest with your staff versus what the consumer is expecting of the financial institution. Is the consumer data being used as the consumer had expected? Or is it being misused? In other words, if the consumer provides you information simply to open a savings account, why is it then being used as to sell to a credit card company or an outsourced company without the customer's approval? So we'll take a look at how you're dealing with the data that you're collecting and its use. We want to look at, you saw one of the conducts, good conducts was disclosure or transparency. So therefore, we'll want to look at the information you make public. Is there elements of it being misleading? Is it biased information? In other words, you only disclose the good points of a product or the good points of the service, and you brush over or you put in tiny print on the back page of a brochure that there's a risk that the consumer should be aware of, or that there's a fee that the consumer, or that or there's a commission. We want to look at, is there fair information, complete information that the consumer can understand is being released. Without good information, you can't expect consumers to make an informed and intelligent decision. It's a basis of responsibility for the financial institution to make sure that it provides that level of disclosure that consumers would expect. We'll look at if we find, if we do audits on files, if we see that there is mistakes being made, accounts being opened when the documentation hasn't been filled, or there's questions in terms of whether the customer actually signed the documentation. We want to look at complaints that allege that the consumer was given information that was incorrect. And based on that type of a review of information, is there then a question that there's a level of incompetency of the staff or of management? Is it, if it's not incompetence, is it simply a matter that there's not sufficient training, that the conduct of the institution is to hire staff, put them on the job and let them figure it out, as opposed to providing a comprehensive and quality training before putting the staff in areas of responsibility? We want to look at what's the pattern of compliance. Is there been a history of compliance or regulatory risks that we have identified that haven't been mitigated by the financial institution? And if there's a record of compliance offenses, we want to find out why. What's the root cause of compliance issues, or why has the mitigation of the risks taken place? Is it because of a lack of awareness or understanding or lack of training that's occurring within the organization? Is it a failure to implement adequate monitoring, controls, and governance on purpose? In other words, that the financial institution, because of the costs of compliance, of the costs of having to mitigate a regulatory risk that management feels is too high, perhaps they're taking a risk themselves in terms of not putting in place the adequate monitoring the controls, the governance, and the practices. And then there's occasionally you run across institutions where they simply operate outside the law, that they're making unethical practices, unethical decisions for the benefit of an advantage in the marketplace. So you can see when you have a quality conduct regulator, it's not just a matter of dealing with complaints. It goes beyond that. If we go back, we are going to look at your business. We're going to look at how the business operates, the complexities, the resources. We're going to look at the culture. How does the culture behave? We're going to look at the actual conduct in the marketplace and how you're treating consumers. We're going to look at then what defenses have you put in place to prevent conduct risks. So that those two slides will give you a good appreciation of what an effective conduct regulator will carry out in terms of its activities. So let's look at the scope of conduct risks. In particular, I focus on the event, the conduct event of the financial crisis of 2007, 2008, in which there was significant regulatory attention on the misconduct that was industry-wide, in particular in the US, and in particular in terms of the mortgage industry, that almost that brought down some significant financial institutions in the States and in other countries, created some financial chaos in some of the developing countries. And you can expect that the politicians, the governments, decided that it was time to focus on a rigorous regulation on conduct. And out of that crisis, these are the key elements that the different countries started. The US, Canada, the European market in particular, focused on looking at the fair treatment of customers, the effectiveness of the governance institution, not the fact that you just have a policy on governance, but has it been effective? The assessment of your risk management and mitigation policies. Again, the conduct in terms of product development, the culture. One I hadn't mentioned previously is a focus on management accountability. In the past, when we would find problems with a financial institution, and I remind you, I'm giving you from my experience, it may be differ in other regulators, but from my experience, it was often difficult to find out who was responsible for causing the misconduct. We clearly understood which financial institutions were involved in the misconduct, but then we want to get to the root cause. What was the process for having made the decisions? Who made the decisions? What was the board's role in approving those decisions? So therefore, you see regulators, conduct regulators are forcing financial institutions to develop an accountability framework where you go through your management and you designate who's accountable for what. So that when a regulator finds that there has been a conduct risk that it needs to be addressed, it can go directly to the management that's accountable to do it. It also is a key element in terms of applying sanctions, penalties, is if we know specifically what the root cause was or who caused it, perhaps we'll sanction the individual, we'll take him out of the financial institution because of his behavior. We will potentially suspend them, whatever the powers of the regulator may be. They'll want to focus on dealing with accountability. So that is a strong momentum currently. I know just being in Ireland, the Central Bank of Ireland for the last few years, that was a key element because of issues of irresponsible management in terms of certain behavior. And then lastly, the focus has been to address the consumer gaps in knowledge and capabilities. by promoting financial literacy and education and awareness. And not just responsibilities on the regulators, but responsibilities on the educational systems, responsibilities on the financial institutions all have a role in ensuring that consumers over time will have the abilities to understand the knowledge and capability to look after their financial well-being. That's a long process and has been going on for 20 years, but it's a never-ending challenge for all of us in terms of dealing with ensuring consumers have the knowledge to make the right decisions. So you have that list of actions that were taken because of the financial crisis. What it required then is the politicians, the governments then looked at the regulators themselves. Were the regulators at fault in terms of not identifying what the risk was that was developing in the early 2000s? And if I may summarize my understanding, in the early 2000s in the States, there was a push that everyone should be entitled to own a house. And the political will was that the financial regulators should ensure that financial institutions are able to promote home ownership. However, without the appropriate oversight or the appropriate powers, what we found was an industry that developed of mortgage brokers, unlicensed or unregulated, started to qualify mortgages. It was found that they would put fraudulent income on customers' applications in order for them to qualify, and put through these mortgages in which they were not sound to begin with. What the financial institutions would then do is they took these mortgages and they sold them off. The comment, the word is securitizing the mortgages. They bundle them, sell them as investments to other investors and to other countries who were interested in a financial product based on mortgages and the interest paid on mortgages. What didn't happen was nobody was questioning the quality of those mortgages. And no one was verifying the information that was being put on those mortgages by the mortgage brokers or the financial institutions. Nobody was taking responsibility to ensure that the mortgage, the lending was responsible. So what happened was, when you build a house of cards without any focus, without any strength, that being mortgages that should never have been approved, the questions start getting raised by investors in terms of what is the quality of the mortgages and the investments. When the manufacturers or the financial institutions refused to disclose what was the quality of those mortgages, the crisis began. There's a complete lack of confidence in the mortgage investments, and billions and billions of funds were frozen as people tried to figure out whether those investments were actually of any value. And we'll see a slide in further on in terms of the cost that this financial crisis caused based on irresponsible conduct. The regulators were then bolstered by improved mandates in terms of conduct in particular. Before, it had been focused on prudential. They wanted a more rigorous and disciplined approach on the conduct of financial institutions. They wanted to ensure that they had then the power of investigations, the powers of suspending products, the powers of sanctions in order to enforce conduct regulations. And they increased the resources available to conduct regulators. Some countries actually created conduct regulators that focus strictly on conduct as opposed to prudential. Other regulators were given a dual task of not only the prudential side, but also to implement the conduct. So there you have, in essence, the modern day cause of why so much focus is on conduct, and why it has a reputation, conduct has a reputation of causing significant harm, not only to the financial institutions, but to the consumers, the marketplace, and even to the country's economy. So let's take a look at what that crisis cost. So you have a graph. I know it may be difficult to see, but I put on there a link if you wanted to check. But this is from the year of the crisis to 2019, and on the left you have the billions of regulatory costs because of misconduct and the type of banks: U.S. banks, UK banks, Euro banks, Swiss banks, over the period of time from 08 to 18. You also have on the middle chart the types of misconduct that was found: the lending issues, charges, conduct relating to charges, disclosure of charges, unsound banking practices, manipulation within the marketplace, such as the mortgage market, money laundering, etc. And then on the far right, this comes out of the EU, this report. They took a look at what was the impact on the equity of the financial institutions. And just as an example, you saw 3 lines showing as the cost of misconduct increased from 0 to 50%, so did the value of the institution. So it demonstrates that there's a cost to misconduct. And here is the severity, where it was estimated by the Financial Stability Forum to have cost $350 billion just in those years. And I could probably add several more billions since 2019 as more charges and more court cases were dealing with that misconduct. So let's take a tour around the world in terms of the types of misconduct that we have seen. We have in Australia a significant uproar by the government regarding the conduct of its financial institutions. They established a royal commission in 2018, I believe, to look at in depth the misconduct that was occurring, not only just in the banking sector, but also looked at the insurance and investment area. Here I've just taken excerpts that dealt with banks, in particular in terms of lending, and the types of misconduct that these reputable Australian banks permitted in terms of the culture of their organization. They have found allegations improper conduct by lenders that involve the falsification of loan applications by bank employees, inflating the value of assets, forgeries of signatures, backdating of documents. In terms of stressed debtors, intimidating inappropriate behavior by bank employees or those outsourced bank debt collectors, harassing about on payments, coercing in terms of signing settlements agreements, unauthorized disclosures of customer information where information is actually sold by staff to third parties, the facilitation of unauthorized transactions by staff members, failure to report unauthorized or fraudulent transactions. In other words, it was found that staff were aware that such things were happening, but there was a complete failure in the conduct of those staff, or the ethics or the integrity of those staff, to actually come forward in terms of reporting the transactions and having management respond to that. It's breathtaking in terms of seeing what they found was going on in terms of what up to that point had been considered to be very reputable financial institutions within Australia. As I say, I could probably have 3 or more slides dealing with the allegations that they found in terms of how insurance was sold, how investments were sold, many of these same misconducts occurred in those areas as well. So let's go around the world. Let's go to the UK. Here you have a chart in terms of the types of products that were missold that created conduct risks. You have in the middle the amount of billions of euros that it costs in terms of penalties on those on the conduct or providing redress back to the customers. And then on the right, you have the number of years that misconduct was going on. Significant. You have in the case of PPI mis-selling, that's payment protection insurance. Almost all the modern countries were allowing credit cards to sell credit insurance. It was an insurance that if you agreed with your credit card that if you were unable to make a payment, that this insurance would make that payment for you for a period of time, 6 months or 12 months. So if you're laid off unexpectedly, if you had health issues and you couldn't make your credit card payment, that was the purpose of the insurance. And it was sold by, in some countries, Canada including, it was sold by saying to the customers with the credit cards or the new credit card customers that out of the charity of our hearts, we're going to give you 3 months of insurance free. But after 3 months, you have to contact us and tell us that you no longer want the product. So there's two significant conduct issues that arose from that. One is when the product was sold, there was not adequate disclosure in terms of that, in fact, it excluded certain cardholders because of their age. People, for example, over 65 weren't entitled to it, yet they were sold the product. If you had a pre-existing medical condition, you were not told that insurance would not be in effect. So there you had hundreds of thousands of customers throughout various countries getting insurance for which they may not even qualify. So that's one in terms of proper disclosure to selling the product. The second aspect was taking advantage of what I would call apathy by consumers. In other words, if you ask consumers to respond to something, I think those in marketing, if you're listening, probably are aware of that. If you ask consumers to respond to something, the likelihood that they'll respond is probably pretty low. So the financial institutions or the credit card companies were, in essence, betting on that the majority of customers will forget that the 3 months is up. And of course, if you miss the 3 month deadline, you're stuck. You have that product for a full year. Or they either have forgotten or they may have even not realized that the insurance was conditional with them responding back to the financial institution. That product was on the marketplace for 8 years. And that's why this is just the impact in the UK, 46 billion pounds. If I give you some other examples, I hope I'm not boring you with examples, but I guess it's my right at this point, was mortgages. I talked about mortgages in terms of the misconduct in the States, but there was also misconduct in terms of selling a mortgage with an additional product. This was again in the UK. It was called endowment mortgages, mis-selling. It said that if you take a mortgage out with us and you increase your payment above your required payment, we will use that extra money and invest it so that at the end of your mortgage, you'll be mortgage free. So if you have a 20-year mortgage, at the end of the 20 years, we will ensure your mortgage will be paid off. However, that wasn't the case. They did, in fact, increase the payments. The consumers were sold that at the end of that mortgage, because they added a little extra money for investments, that the financial institutions would use that money to make profits, and those profits would be used to help reduce the mortgage and have it paid off. That did not happen. So you had people reaching 20-year, 30-year, whatever the length of the mortgage may have been, with full expectation that that mortgage was going to be paid off, and it wasn't. So there you had an issue of how well was that disclosed to the consumer? What was the assumptions made in terms of the ability of the financial institution to actually use those funds and make profit to be able to meet their obligations as sold to the consumer? Did the financial institution actually have the skills to use that money and make the anticipated profit that it supposedly said it could? And that went on for 4 years. As people's mortgages came due, the complaints, of course, increased significantly for the regulator in the UK. And that resulted in, as well, a provision of $1.9 billion, pounds. So I'll leave that with you in terms of examples, as opposed to going through every area of misconduct. But as you can see from the length of time it was in place, you can understand why regulators are now looking at what are the controls in place that you are screening now in terms of what that product, what are the conduct risks that's potential with those products, instead of waiting for, in the case of PPPI, eight years before there was enough complaints that the regulator reacted and applied the sanctions and dealt with the mis-selling. If the question I have to ask as a regulator is, how could it have lasted that long? Was the financial institutions not paying attention to what the consumers were complaining about? Surely after 8 years, there would have been enough data from the complaint data that you would have seen a trend where your risk control, your compliance people would have twigged to the fact that there was a problem and gone into to define exactly what that problem was. But it didn't happen. These were significant financial institutions. All of them have had their share of these type of scandals. And you can understand why we in the conduct business have become so rigorous in terms of taking a look at how financial institutions are conducting themselves. So we've talked about the US mortgage market. We talked about Australia in terms of its lending, suitability of lending, and the conduct of staff and management. And now we took a look at the UK. So then let's look at sources of conduct risk. So some of the risks are generated by the organization, the structure of behaviors within the organization. So let's look at a couple of factors in terms of behavior. One is, has the board of directors, has senior management put in place a governance structure that deals with the control of the organization, the accountability of the organization, has set out what exactly are the values of the organization, the expectation and accountability in terms of ethical and responsible behavior, and clearly defining and monitoring, putting in place the monitoring capacity and the controls that will enable the identity of any responsible conduct that may occur. So if in fact that governance structure isn't in place, it's a key area we would feel that is a source for potential conduct, misconduct rather. I've already talked about the culture in terms of within the organization. And is there any attempt, again, looking at accountability by the board, by management, to put in place to ensure that the organization is aware of what are the values of the organization? What do we might mean by fairness, integrity. What do we mean in terms of having a culture that demonstrates the firm's attitudes and behaviors towards the consumer? That it's a culture that respects the duty of risk management, that respects the purpose of audits, and provides incentives to promote responsible behavior at all levels of the organization. We look at business plans. We've talked about that, but in terms of when there's a lack of competition, whether it be for a particular geographical area, for a particular type of product that's occurring in the marketplace, that lack of competition in the marketplace can distort the behavior of the organization. It can feel that it can take advantage of the consumer because the consumer does not have a choice. If it wants that product, then it will have to take the product as the financial institution prices it, as it discloses information on it. There's no choice in terms of comparing it to other products. The same is true in terms of a geographical presence. When I was there in 2015, I had the ability of working with NBC, where we went out to some of the villages. Specifically, I wanted to have a conversation with a chief of a village that is run by a woman, and a village that was run by a man. And we had the opportunity to spend morning with one and an afternoon with the other, look at how they deal with their financial needs. In particular, of course, most of it was lending. And a key component was in both those villages, there was only one microfinance organization that was available to them. There's no ability for them to see whether they're actually given competitive rates, that the fees or the commissions that are being charged are actually appropriate, that the calculations are correct. And there is significant opportunity in these villages where there's no competition for conduct risks to be common. This requires a regulator to be very proactive in terms of, in particular, those types of conduct that's generated by the marketplace through a lack of competition. So that's behaviors, conduct risks coming out of the structure of the organization through governance culture and its ability to deal with competition. Let's take a look at external environmental factors that affect the conduct risks. We take a look at risks that get posed because the firm's strategic responses to the current pressures are inadequate. Perhaps because, I'll give you an example of, this was in Ireland. There was a huge pressure on mortgages. There's a housing push to buy housing, hence there was a push to sell mortgages. And the firms came up with the response to that marketplace. They came up with a mortgage that you are guaranteed a fixed rate, but if the rate goes down, you would enjoy the benefit of the lower rate. So yes, they were responding to the pressure of a good marketplace to sell your mortgages, and they put in place a condition which should have been caught by the financial institutions' risk management. And what happened, if you recall, in 2021, what happened to the interest rates? They went from 1 or 2%, whatever it may have been in Ireland, to 5, 6, 7% on the mortgages. Meanwhile, the financial institutions had fixed it at, for example, 1%, and were unable to increase the interest rates to ensure their profitability. And they reacted. They reacted by encouraging consumers to renegotiate their mortgage so they could get out, so the financial institution could get out of that clause. So the new mortgage would no longer have that clause, but they would provide some sort of incentive or reason why the consumer should renegotiate. Hence leaving the consumer worse off in terms of now having to deal with increased mortgage rates. It is one of the most significant conduct issues in the Central Bank of Ireland during the 2001-2003 years that I was there with dealing webinars. If we continue down the external factors, some of them are related economic changes affecting the firm's expectations regarding future performance. That certainly can apply to the fact that the interest rates went up on the cost of borrowing, and they had fixed rates on their mortgages. When there's unexpected squeezing of mortgages, so if there's a new entity that comes in, for example, a fintech that is offering bank-like products at a faster, lower cost, perhaps the institution's going to be forced to reduce margins on it, and may take conduct behavior in order to protect its margins, somehow increasing fees to consumers or whatever it may need to do to protect its self-interest. External factor, of course, marketplace innovation and the impact that fintechs have had in terms of their flexibility and the lack of regulation that fintechs have enjoyed versus financial institutions that have had to deal with compliance and conduct regulations. You've had changes to third-party funding. In particular, I suspect that applies to microfinancing, where third parties are changing the conditions. Meanwhile, you've already put out your lending products at particular rates that aren't flexible. Each of these conditions can force the management to rethink its conduct. It may have wanted to be ethical, but when it's faced with profits, the pressure by shareholders, pressure by the board to ensure profitability, the firm takes actions that potentially they may regret later when the regulator takes a look and sees how they responded to these conditions, mainly at the cost of the consumer. You have risks caused by technology. So technology, because of the costs of having to deal with data security and controls, you have some of the smaller financial institutions that just have problems affording the costs that are associated with ensuring proper data security and the necessary controls. The costs of ensuring there's network integrity and redundancy, in particular as financial institutions push customers more and more online, the need to ensure that if you're going to do that, that you ensure the risk to consumers of having to deal with online banking is minimal. You have, again, because of perhaps costs, the weak quality control and testing of new applications. You have the costs of having to deal with cyber attacks. You have the over-reliance that's starting to develop in terms of relying on third-party or fintech-based infrastructures, where perhaps the software hasn't been audited or verified as stringently as it should have before the financial institution adopts it. You have the potential in terms of misconduct is using the logarithms of the web-based sales to attract consumers to make a particular type of decision online. You can do that by having special offers, limited time offers, and putting a clock on how they have to make a choice soon. You can have it by more attractive graphics leading the customer to a particular service or product as opposed to one that would be more appropriate. And you have the fact that many existing institutions may have old technology And the new ones are able to come into the industry at a cheaper cost and be licensed, and are breaking down the barriers to entry that institutions used to be able to rely on, which was of large costs in technology. And with fintech, that those costs have certainly been reduced. So let's go back. Sources of risks. How well is the organization actually structuring itself in terms of conduct? How is it ensuring that its culture is actually abiding by what it expects in terms of good conduct, good compliance, good fairness? How does it react to the fact it has an advantage in the marketplace? And does it take advantage of having a dominance in the marketplace? You look at the economic conditions or market trends or consumer trends that may alter a firm's expectations or what their assessments were, and for them to react perhaps irrationally from the point of view of conduct, but rationally in terms of trying to protect the firm in terms of its profits. And then finally, outlined the risks that can come from the various elements of the era of technology. So then again, to reinforce, so by the end of this webinar, I think you'll have a good idea what we mean by conduct risks and examples of risks. So let's go through common retail risks that in the various marketplaces, countries I've been in are typical in terms of what a conduct regulator will find. You have the use of quotas on lending officers causing high consumer debt is one of the consequences, but also unnecessary debt being given to consumers when in fact the consumer had no need for the debt. You have unregulated and shadow banking, subprime lending. In other words, gouging consumers that need the money but don't necessarily qualify, but you increase the interest rates to such an extent that it's attractive to lend to them. You have misleading advertising and calculation of interest rates, predatory lending for the purposes of repossessing the security and resale of land. You have the lack of effective disclosure as to what is the actual costs of lending. You had a limit placed on interest rates in Cambodia, and what we saw was in fact the increase in fees and commissions to offset what the industry felt it deserved in terms of payback for its lending of its lending practices. You have general product risks, again, misleading, inappropriate marketing of products. You have a lack of effective disclosure, whether it's regarding fees, contracts, changes. You have abusive terms and conditions. You have, in most contracts, the arbitrary right to make changes in the terms of conditions. You will, in some cases, find inappropriate products sold to vulnerable consumers that don't know better, aren't informed, or you sell them products, the high-end products, when in fact a low-end or medium-end product would have been more appropriate for the consumer. You have sales that is driven by compensation, so it's aggressive. It's abusive in terms of repetitive contacts to consumers to get them to purchase. You have inappropriate advice to avoid perhaps conflict of interest. You have the product design, poor product design. I talked about those mortgages where the product that was designed led to significant misconduct. And you have, this is a conduct I hadn't talked about before, negative option selling. And this is where, if we recall with the payment protection insurance, is you offer a product, whether it's insurance or any other product or service of the bank, and you give it to the customer on a condition of whether it's free or a low interest rate for a period of time, or that it's without fees or commissions for a period of time, and that it will resort after a period of time to higher interest rates, higher commissions, higher fees, unless the consumer responds. And the negative option is that unless the consumer gives the bank a negative option, the consumer is going to be sold that product. And usually it's locked in for a period of time, usually a year. So that is a common conduct risk that we try to address when we look at how products are sold. Other types of risks in terms of conduct supervision is we looked at the collection, the sharing, and misuse of consumer information. Does the institution actually ensure proper access? In other words, that a teller can't pull up the lending profile of someone else that they had no business taking a look at, that there's appropriate controls on access. You have abusive debt collection, where there's harassment, where the financial institution outsources it, potentially to very aggressive collectors who will intimidate by attending the employment location, or go to the village where the debtor is present and intimidate the family, go at all times of the night, whatever it may necessitate from the financial institution's point of view, to coerce payment of the debt. Often we see ineffective consumer dispute and redress mechanisms, which was pretty evident in Cambodia when I was there in 2015. As an example, I took a look at some lending documents of a microfinance where it talked about if the consumer were to make a complaint against the microfinance, that if the consumer's complaint was not founded, the microfinancing had the right to sue the consumer for the cost of having to deal with the complaint. So from my perspective, from a regulator's perspective, all that does is intimidates the consumer so they'll never complain. What consumer is going to complain if they have the threat of a financial institution, of the power of the financial institution to go after them because what they thought was a complaint was in fact not a valid complaint? And that was rather shocking for me when I took a look at some of the documents I had read back in 2015. Another area are the financial institutions taking advantage of the lack of consumer knowledge. In Cambodia, with the advent of unsecured credit, clearly you're dealing with a population that had not been used to the concept of unsecured credit and the costs associated, the conditions that are associated with it, just the concept of repayment and the importance of repayment on time. So what was the reaction within the financial institution, realizing that if it's going to get into the unsecured credit and also with secured crediting as well, that it's going to adjust its method of disclosure, its method of providing advice, the method of in ensuring suitability of the lending, and the monitoring of the sale of the lending is all in place, since you're dealing with a marketplace that's adjusting to the concept of debt. And was in fact was that the case? My view in 2015 was no, it wasn't. Since then, there was the credit bureau that's been put in place, and significant efforts have been made to adjust to the fact that there needs to be support in terms of improving the consumer's knowledge and ability to deal with debt. So there you have some examples throughout of lending risks. There are product risks, other type of risks that conduct risks that we'll be looking at from a regulator's point of view. Now let's take a look at the issue of systemic risks. this term became important because of 2008. None of us in the regulatory business would have realized that the sale of a simple product, that being a mortgage, could bring down financial empires in terms of financial institutions, bring down instability to financial sectors, whether it be Ireland, Greece, a number of other countries that had invested in American securities, asset-backed securities. None of us had realized what had changed in the financial system. The system was now offering more complex products. It wasn't a simple mortgage that would be with the financial institution, and you meet with the financial institution, you make your payments. No, what the financial institution was then had the right to sell your mortgage to a hedge fund or whatever it may be, who then have control over the mortgages. That the products, whether it be the mortgage risks, were passed on from the mortgage broker to the mortgage institution, to the hedge funds or to other investors. The risks were passed on like we hadn't never realized before. We always focused on the risks clearly being with the financial institutions in terms of dealing with credit. You also have the international financial institutions setting up in various countries where they're bringing their products into a country. So the product is not just being used in one, but maybe in multiple countries. In particular, this is an issue in the European Common Market, where there's 27 countries, I believe, all with different levels of quality regulations, quality regulators, all being interconnected in terms of risks. So based on the internationalizing of financial institutions, the internationalizing of products and services, we learned a significant lesson with what happened in 2007 and 2008. And I already talked about the political ramifications where they brought in significant compliance burden on financial institutions. They created significant powers and mandates for new conduct risk regulators, or accentuated the powers and mandate of existing prudential regulators. And they have put in place the need for countries to meet international standards. And that was in terms of an earlier comment before we started my presentation. There was a concern about the fact the reputation of Cambodia, if it intends to ensure a place in the international financial marketplace, that it's got to meet what international investors, what other countries' regulators would expect should be done in terms of regulating conduct in the financial institutions that operate within the bounds of Cambodia. So in terms of systemic risks, we know the impact when it happens. We know the losses that can happen to consumers, to investors, to the economy, the unrest that it creates in terms of destabilizing some governments. And we cannot tolerate that type of risk occurring in the marketplace again. Hence the push among the G7 countries, the G20 countries, to adopt common regulatory standards across the board, ensuring that the principles of conduct, common principles of conduct are put in place, and where needed, that the appropriate standards, specific standards of conduct are set in place that ensure consumer protection. So that's the concern that has existed since 2007 and continues to this day. If anything, the complexity of the marketplace, the international marketplace, is only accentuated, in particular with the introduction of fintech So that is a major concern of conduct regulators, is to make sure we're identifying what may be systemic risks in conduct. So then, if I may progress, let's talk about your financial institutions. And this is rather a high level diagram of what a typical financial institution would have. You have a legal department providing advice. You have product development that looks at new products or amending existing products. You have marketing and sales. You have the technology department. You have the sales and distribution area, and you have the controls, the compliance and risk management on audit controls. So when we find that we've had a conduct risk event, something that's gone wrong, the regulator wants to know why it happened and where it happened and who was responsible. We are no longer just holding the financial institution as a whole guilty in terms of non-compliance, or the financial institution as being the sole entity that we penalize for sanctions or fines. We are going to look at what was the event, how did the event occur? So let's take a look at a couple of examples. We had a credit card company that decided to farm out its back office. The statements, transactions, interest calculation. It contracted it out to an outsourced firm in another country. And they continued with their disclosure, which talked about fees and talked about how to calculate the interest rate, and other aspects were disclosed. What we found when we listened to complaints, a common issue, was people couldn't understand how the interest that was calculated on their statement was done when they used the calculation that is in the disclosure document. So clearly, either the disclosure was wrong, and therefore, who wrote this disclosure? Was it somebody in compliance? Was it somebody in legal advice? Why did it happen? Or perhaps the disclosure was correct, but somebody who looked for outsourcing because it was going to be cheaper and we're going to make profit didn't do the due diligence. In other words, they didn't put a governance structure in place in terms of when you're outsourcing a product or service, you're going to have a significant due diligence in terms of how that product is going to be produced by your outsourced entity. Or perhaps it was somebody in technology that was making a mistake somehow in terms of the software for calculating interest. So when we go into a situation where we're trying to find a root cause, if we don't have a financial institution that has set out its accountability framework, in other words, who's responsible for what, it makes it very difficult for a financial regulator to actually find the root cause and penalize provide consequences for creating that conduct risk. Hence, I tie that back to a comment in the previous slide, where one of the initiatives is to make sure financial institutions are starting to put in their governance an accountability framework that talks about specifically who's accountable for what. What is the board accountable for? What is senior management accountable for? What's line management accountable for, etc. Significant undertaking, I understand, but one that we need as a regulator to address the sources of the risks. Maybe if I give you another example, We, again, through monitoring complaints, we've had complaints about the fees being charged for non-sufficient funds, bounce checks. So we took a look at the disclosure document, similar to the other product, and we laid out we took a look at the customer statements, calculated my regulator officers would calculate and try to find out whether the disclosure matches the costs that were incurred, and we couldn't match it. The same issue comes up. So there's a problem in terms of calculating fees, charges. So is it the disclosure that was wrong? Is it the sales? Is it the calculation perhaps in technology that was wrong? Did product development make a mistake? Who was at fault? So I don't want to be repetitious, but I think you get the hint. In terms of a regulator, a proactive regulator is going to look for the root, not just that the financial institution was responsible, but specifically what areas within the financial institution were involved, and in particular, who, from the management perspective, should have seen the conduct risk that would develop because of the lack of perhaps the quality of control that was used in the product that was issued. So I think I can provide you numerous examples of a regulator trying to find out in these areas who's responsible, in particular product development. But perhaps that's for another webinar. But I'll give you an idea. You should, given you're coming from financial institutions, that you may work in those areas, and you are now an expert in the perspective of a regulator, start asking these questions in terms of what is the level of due diligence, who is accountable, and are all the people involved, say in product development, does product development involve all those that are necessary to make sure conduct risk is minimized in terms of product? So feel free to take a look within your organization. So then let's look at Cambodia specifically. As I mentioned, I was here with IFC in 2015. We met with several parties, several microfinance organizations, the associations as well. And I asked for samplings of documents to take a look at. I looked at websites. I was provided a lot of information from the institutions themselves. And we issued a report in 2000. IFC issued the report called Promoting Financial Consumer Protection in Cambodia. And we talked about bringing consumer protection into Cambodia. And we talked about areas that it would benefit in terms of consumers having that level of protection, the confidence in the financial sector, the stability within the economy by having a diligent conduct regulator in place. But we then took a look and created a list of what we saw in terms of risks. And I won't go through them because these are the same risks we talked about in the previous slides. Perhaps one that's a little different is what I found concerning was an effort by financial institutions for lending to underage youth, and the suitability of such lending. Clearly, I understood that the youth were wanting their motorbikes. They use it to potentially for employment. But I was not convinced that the suitability or the evaluation of the suitability was appropriate. Everything else, all the other risks are quite common. The bottom one was a lack of rigorous regulatory oversight in terms of conduct. You had regulatory oversight on the prudential side, but very little, if any, focused on conduct. So then, returning back in 2023, I met again with some institutions. I met with individuals who are informed in terms of customers and their relationships with their financial institutions, and I have to report back in an informal manner that many of those conduct risks associated with the consumer experience that we saw in 2015, that's common in other countries, are still being observed, and the level of conduct supervision has not significantly improved. Although conduct risks are observed are a common experience in jurisdictions, there's not an equivalent level of regulatory protection for financial consumers in Cambodia, as seen in many other countries. And you can refer to the link that I have, which is a survey that was done by the World Bank, looking at the consumer protection frameworks that were in place among the countries, and rating them in terms of their the level of protection afforded to financial consumers. So I'm drawing to a conclusion. In the marketplace, from a regulator's point of view, we look at the marketplace and we ask who has the power in the marketplace. You have two entities, you have the consumer and you have the financial service providers. And let's take a look at the balance of power within the marketplace. The financial service providers can decide on the level of profits that they want from their customer service. They have the ability to and the power to promote and persuade through marketing and sales. They have the power to set the terms and conditions. They have the control in terms of how much disclosure they're going to issue or how transparency they're going to be in terms of which products they sell. They have the decision in terms of how much they spend on quality controls of product design. It has the power of setting the price. It has the control to access who can access the financial services. So then we look on the other side. What do consumers rely on in terms of protecting their interests? Well, recently, over the last 20 years, we felt that education and literacy was going to be going to solve everybody's problem. It doesn't. We have felt that consumers would deal with financial institutions that have a reputation in which they can trust that they'll be treated with fairness. But given the multitude of financial institutions, the new entrants into the marketplace, the ability of consumers to place their trust in a financial institution, it can be rather limited. So then what we have seen in this webinar is we have turned to balancing that marketplace with regulatory principles and standards of conduct focused on consumer protection. So the more irresponsibility we see on the left side, the more likely you're going to see stronger and more stringent standards and principles applied with more rigorous regulatory oversight. So the compromise is in terms of the financial institutions themselves carrying out risk mitigation through controls, through governance, and limiting the need for stringent regulatory standards and consumer protection. But until the regulator sees that balance, you're going to see heavy compliance issues develop. So in terms of the financial institution, part of this presentation was mitigation. The first line of mitigation is with the financial institution. They're the ones that create the product. They're the ones that provide the service. They're the ones that deal with the customers. They must carry out the due diligence required to limit the potential for conduct risk. They must develop a comprehensive governance system that sets out a clear and comprehensive framework for managing and operating institution. A framework that sets out expected cultural norms, expected values of the organization, and the expectation that the board, the management, the staff will carry out their responsibilities in an ethical manner. The unchecked misconduct by financial institutions, as we've seen, can create significant reputational harm in the marketplace, weaken the consumer and investor confidence and trust. It can be prevented by making sure that your internal monitoring and compliance and audit and risk management are in place, and that the quality is scrutinized by the board, the management directors. Even the shareholders have a role to ensure that the financial institution in which they are part owners carries out a governance framework that minimizes the possibility for misconduct events. As we know from this, the examples I provided, misconduct events can attract the attention of regulators. It will definitely attract the news and media and the social media, especially with the use of Facebook and other social media. Word spreads very quickly in terms of misconduct of a financial institution, in terms of the treatment of consumers. And of course, the general reputation can be affected in terms of the views of the public with the long-term reputational consequences. So the costs, you have seen a slide where $350 billion worth of costs have been incurred just up to 2019. Was it worth it? If the institution put in place the proper mitigation, the proper controls, the proper governance, the proper verifications and monitoring, would they in fact have enriched their shareholders by $350 billion, as opposed to simply having to pay the money out to consumers that they have harmed, and provided funds to regulators as part of sanctions and penalties? I'm not sure the equation there is fair. That it was a fair trade to have that level of misconduct and pay $350 billion just so they could escape the concept of good conduct. So that ends this seminar. I hope I met your expectations. I would certainly hope in the end you can understand what are the aspects of misconduct, what's typically going on in financial institutions, why the increase in terms of conduct regulation that has occurred internationally and hopefully will increase in Cambodia. You saw within the last year and a half the law on consumer protection that was issued recently. It focused more on providing prohibitions of conduct, like prohibiting misconduct, prohibiting aggressive sales, which is a bit different than conduct principles, which looks at setting specific standards as well, saying not what is prohibited, but tells the financial institution what is expected. It's given that such behavior such behavior should not occur in the financial institutions. But then what conduct standards will do is actually lead the way and provide minimum standards that will apply to all institutions and set in place in the marketplace a level playing field so that all institutions know what the game to play is. And I'll provide you with one last example. I was in Cambodia and spoke with an international bank, and they were upset in that internationally they have to abide by the conduct set by their international holding company, which is under a more rigorous conduct framework in another country. And therefore, they, in their products, were promoting savings accounts, and their interest rate was 6.5%, if I remember correctly, but it was based on compounded interest monthly. And based on their international standards, they would advertise the 6.5% and disclose that it was compounded monthly. But then they look out the window, and across the street was another financial institution that put up big, huge signs saying savings account 7%. And the concern of the international was that sign gets the customer, when they look at the sign on the international saying 6.5, they look at the other institution saying 7, they will go to that institution thinking they're going to get the better deal. Once a consumer gets into a financial institution, my view is they are basically captured. They're going to get sold that product. The issue was, why didn't that other financial institution put down how that interest rate was calculated? It was 7% on a per annum basis. A interest rate of 6.5 compounded far exceeds an interest rate of 7% that's done on an annual basis. So there's no standard in terms of ensuring that when there's advertising of fees, advertising of interest rates, that consumers will have the ability to understand that there's ability to compare apples with apples and not try and compare apples and oranges and simply go for what they saw was a higher rate. So that was my last example, and I wish you all the best. I thank you for your interest in consumer protection and in the concept of conduct regulation. And I wish you best and a nice, pleasant weekend. Thank you.
Thank you, Jim, for your excellent presentation. So there are some questions on the chat. I know you have not read them, so why not you spend some time to read them, and then we will sort it out one by one. So I will first answer the first and the second question, and then you follow. And so now you read while I speak. So for the participants, so a few points. So first, I mean, just in case people got confused, when we say consumers, it means individuals, it means natural person. The word consumer is more legal term, so it does not mean that in the consumption sense, it simply means natural person vis-a-vis legal persons. Legal person means legal entity. Now, the other thing is, as some of you know, financial consumer protection framework has a range of elements, which Jim already explained in his presentation. Under the current World Bank Group standard, there are 6 areas. So under such a modern framework, which is an international consensus, financial education or financial literacy is only one of those elements. So financial education does not equal financial consumer. So in Cambodia, even until now, whenever we say consumer protection, people will immediately say, oh, financial education. We are already doing financial education. Yes, if you are doing it, and that's some progress, that's good. But financial education is only one of the elements. There are other elements that are necessary and equally important. So in future, let's remember that whenever we say financial consumer protection, it does not equal to financial education. Financial education is only one of the 6 big areas of FCP. So hope that everyone understand this. And in the case of Cambodia, there are obviously the major missing gaps. So we will see from the what is really the gap. So the question is saying that if there are misconduct staff in the financial institutions, what will you do against them? And then whether or not they are allowed to still work in financial institution, maybe in another financial institution. The answer is no, up to a certain period or for their lifetime. So in some other country, the sanctions against financial institutions or individuals on the misconduct is actually on internet. You open the regulator's website, you will see that they issue sanctions, they number that. It will be like sanction number 1, sanction number 2, sanction number 3. They will mention the specific financial institution's name. They will mention specific individual's name. And those sanctions or penalties, they are actually very high. So it could be financial penalty, it could be a revoke of your product approval or as part of your license, removal of management, and the individuals, they will be barred from financial services for like 5 years, 10 years, or for their lifetime. So it will be open on internet, everyone can see it. They will never be able to work on the financial industry if it's lifetime or 5 years or 10 years. So, and if there is really serious misconduct, they will be sent for criminal prosecution. So the question asks, if, for example, if they commit a fraud, the word fraud, it means criminal offense. So obviously the person will send for criminal prosecution. And once a person is under criminal prosecution, normally it will mean that this person cannot work in the financial service industry for their lifetime. And obviously the court will sentence them to a certain number of years in prison if it is really a fraud. So in the case of Cambodia, the major gap is that financial regulator does not have a specific mandate yet. And this mandate can be given by a financial consumer protection law. For example, Philippines has one, Malaysia has one. But to have a law is going to be difficult. We are not talking about the general law, we are talking about financial consumer protection law. This is not likely to come in the next 10 years or 20 years. So what Cambodia needed is for the central bank to develop a general regulation on FCP. This is typically the model in Asia across the countries. You look at Indonesia, Sri Lanka, Thailand, or China, or other similar places, or even India, you will see that there is an umbrella, means a general regulation on financial consumer protection. And under the general regulation, there could be other things issued. Those kind of things may be called a practice guide, maybe a specific regulation under the umbrella regulation, maybe a guideline, or maybe whatever. So this kind of framework is not yet in place in Cambodia, and our objective is to help the authorities to put in place such a framework. So for the participants here, please understand that there are many gaps, and then we need to work on those priority ones. It's not just about financial consumer protection, and it's also not just about complaints management. Complaints management already there, and we have also revised the complaints regulation, and there was a public consultation, means consultation with the financial industry workers, I think early this year or end of last year. And this revised regulation, it will eventually come out. And I will post here. So Jean, for you to check in more and more specifically about the United Kingdom case. So for the case that you had listed, so eventually any sanctions on those institutions or individual, this is the second question. Over to you. Sorry, Jean, you are on mute.
Was it the UK or the Australian?
UK. Can you see the chat at the bottom? Click on the chat, then you will open. You can see the question.
Yeah, I'm on.
Yeah, okay. The second question. So you say Royal Commission. Royal Commission, this should be Australia,
That's
I
Australia.
think. Yeah.
All right. In Australia, if that's the question, several of the in the Royal Commission, they forced the chairman of the boards of the financial institutions that were involved in the misconduct and the CEOs to appear before parliamentarians. It was extremely political. And to my knowledge, at least 2 of the CEOs of these major Australian banks resigned, as well as certain members of the management. In addition, you saw the regulator was given much more authority, and the regulator was also criticized in the report in terms of the lack of discipline that they applied for in terms of identifying these risks. So the major impact was major realignment of management and CEOs. I don't recall offhand the amount of sanctions or penalties, but that report is available online if you would like to get more information.
This question is about your slide 11. That financial institution can go above and beyond requirements of law and regulation. So the question asks whether or not you can share some good practice on this matter.
Well, this ties into putting in place a comprehensive governance structure. And in the governance structure, you're going to define what you want your culture to be. You literally will say, what are the values that the institution has? You'll take a look at areas of compensation in terms of whether what type of culture that compensation will create. You'll look at the training. I mean, I could go on in terms of the amount of detail that a governance structure should focus on, but all of it should lead to the values that the organization wants to create in terms of the culture. And in particular, an important aspect is to monitor the culture, because you can have, as I mentioned in this slide, you can have management creating its own culture outside of what the board thought was going to be the appropriate behavior. Or you may have line management because of being forced to, under quotas, to do misconduct, creating their own culture that senior management isn't aware of and aren't monitoring. So it if the financial institution wants to be secure in terms of a good culture, then it's got to define it. And you already have at the start of the presentation, you have what is the expectations of good conduct. You have a list that's required by NBC and its regulations. That those principles of conduct should be in your governance, and that should help set the tone from the top as to what's expected by the board, the owners.
I add to what you say, which I fully agree. So a good example will be that he asked for good practice. That typically in developing country, the law or regulation is often not existing until in recent years. Or even if they are existing, it may not be comprehensive enough. In those cases, it's very common that the leading institutions, means the financial institution, the good financial institution, they will actually behave above and beyond the requirement of your law or regulation. In your case, whether or not there is a law is still a question, right? So, and how do you do that? Remember that there are international standards. You can follow international standards and then make it more specific for your own institutions. This is actually common and is not something unusual. So I hope that this answers that question. I think while you read the long question, which I had not read yet myself, so I will answer the question about the interest rate. So the question is about whether compounded interest rate can be charged before non-performing loan. I think the question, there are two aspects. So the compounded interest is typically more for the savings product. But you use the word non-performing loans, so I guess you are asking for the lending product. In the case of developing country or in the case of Cambodia, it's more a question of disclosure. Are you charging a flat interest rate on the original balance, or you are charging a proper interest rate on the declining balance? Are you revealing those kind of information? And often, particularly in the retailer's credit, not retail credit, retailer like department store and mobile phone seller, etc. They will say, oh, 0 interest rate. So you can buy my mobile phone with 24 installment payment, 0 interest rate. That's of course not true, right? So if you look at their monthly installment, if you calculate it, the interest rate may be 40–50%, but they will still advertise 0 interest rate. So those are the kind of typical issues, typical problem in financial consumer protection. And I'm not saying that this is widespread in the market, but at least, I mean, some years ago, this was very common in some market. Maybe it's changing now in Cambodia. So over to you, Jim.
I'm taking a look at the last question. Currently, there's a group that cheat clients by acting as staff of banks and microfinance. They call the client to convince them that the bank will discount interest rates, schedule approval loans, win lucky draws, etc. Then ask the client to send money to them. Is it possible associate work with related authorities to help on this or other actions to mitigate this? Yeah, that's a universal problem of fraud in all the countries. The regulators, if the regulator should do 2 things, conduct regulators should do two things from my point of view. One, it should be putting in requirements on the financial institutions to put in place educational programs to inform consumers of the fraud. They should put in place processes where they tell the consumer that the institution will never contact them by these particular methods. Explain to the customer that the only way the institution's going to deal with the consumer remotely is through a particular process. So there's pressure on the financial institution to try and tighten how contact will be made with the client. So the client will know that if they get a call, chances asking them to buy a product, it's not going to be their financial institution. So that's one aspect, is asking the institutions to educate the clients on what's going on in terms of fraud, and putting in place limited ways of contacting the consumer that can be taken advantage of by fraud. The second is, of course, when the trends develop, that the financial institutions among themselves in perhaps through the associations create a hotline, so the institutions advise each other in terms of what's the newest scam that's going on affecting clients, so that the network, I saw that in United Arab Emirates when I was working there, that they set up basically a center in the association that would immediately, within minutes, notify other financial institutions, who could then send out the warnings out to their clients. And then, of course, making sure that the police are fully informed when these events occur.
Yeah, I further to that, I think the audience knows that around East Asia, only in Cambodia, there is a big circle for scam, and many of them are actually based in Cambodia. So they are normally foreigners based in Cambodia, but also based now in Vietnam, and used to be in the history based in Taiwan, and also some people based in Philippines. So there are all kinds of scams, and which the authorities are cracking down. So this is less to do with financial authorities, so more to do with the police ministry, and there have been almost daily news on these kind of scams. So, and some of them are related to lending, so but normally not the staff of the financial institution. It will be something like, okay, you are a university graduate, you graduated for 6 months, you cannot find a job, and then suddenly you see an advertisement on training. It's our company offers youth training for university graduate. After our training, you will be able to find a job, and this training is basically free. So you sign up for it and you join the training. But actually the training is not free. The training is actually financed by a loan company, by an informal lending company, or maybe even a formal one. So although you join the training, but your fee is paid by a lending company. So after you finish the training, then you need to repay them per month, and the cost is not low. So you are basically like get into a trap. So there are cases like that. Actually, I saw a case, the university graduate actually suicide. So he suicide and it became a news on the news media. So something like that, it happens from time to time, and this is normally called telecom scam. And so the other thing is more the formal one, is there are loan brokers everywhere, particularly on mortgage loans. So typically these loan brokers are not regulated, just like in North America before 2008. So most of them, I would say that they are serious because they need to make money and to attract clients. But some of them, they also have problems. And financial regulators typically do not regulate them. And typically is the business registration agency which will regulate it. An agency like Ministry of Commerce. But this depends on the country. In some countries, those agencies are effective. Some countries, they are basically just no use at all. So, and what the financial regulator can do is, as James said, is to send out the alerts and to monitor the market. And actually, the ABC can also do some of this work. But unfortunately, this function is not yet with the financial regulator. A real financial regulator, you go to their website, you go to the FCP module, you will see that they are market alert, market monitoring things. They will say that, okay, 2024 alert number 1, 2024 alert number 2. So they will monitor the market and then alert all the market player and consumers on what are the new forms of inappropriate practice or scams. And they will publish it on newspaper and they will send it on mobile phone. This is not yet happened in Cambodia. This is something that need to happen, and we hope that the regulator will soon catch up. So thank you. And then the next question, over to you, Jim. Sorry, you are on mute again.
Relates to conduct risk mitigation, how to build or deliver risk awareness to the risk owners. Within the financial institutions, there normally is 3 lines of defense in terms of dealing with risks. You have compliance, dealing with compliance risks. You have risk management that deal with risk overall in terms of the organization. And then you have audit that, of course, is dealing with risk events after the fact in terms of gaps, in terms of what mitigation should have worked. So each of those roles should be integrated into your organization. So, for example, if you have an area dealing in product development, you should have risk management and compliance as part of that team. When they're involved in those discussions, they'll be able to identify the risks that may come out in terms of a new product that was being developed, or perhaps an enhancement that wants to be made to a product, or the way it wants to be sold to the consumer. By integrating those 3 control functions in each of the areas, in terms of risk management, clearly IT is an area that risk management should be a part of in terms of when they do updates, when they do quality control, when they bring in outsourced IT. So it's a matter within your financial institution, how are those lines of defense utilized in terms of the other functions? That will be one of the aspects we would look at in terms of the organization itself. If we find out those 3 lines of defense are basically silos, then the potential for conduct risk is significant. So again, going back to your governance structure, you should be defining exactly the role that those defense mechanisms will play in terms of the operations. Question number 2, how can we protect customers from hacker frauds? Because some customers, they have limited understanding related technology risk and scam. That's an excellent question. It's a problem I don't have a solution to, because one of the issues that tied in with dealing with financial access and financial inclusion was that technology was going to solve the problem, because you wouldn't, people can use technology to access their financial products. But there was no significant concern in terms of the fact if you give these people technology, they don't have the skills or knowledge in terms of being defensive. And I think given the sophistication of the fraud and cyber attacks, that remains a significant problem for consumers, uninformed consumers. And I don't, maybe Jinzhang, you have some comment in terms of solution, but it in all the countries where technology is involved, the sophistication of fraud and consumers is unfettered.
Yeah,
For the first question, I mean, Jing already answered. So the basic concept is that inside a financial institution, you need to have a conduct risk management framework, which I think this can be a topic for some training later. So typically a framework will mean that you have strategy, you have policy, you have process, you have specific responsible person, and then the second line and the third line. The second line is risk management, third line is internal audit. And those kind of people need to check and then audit. So those are the type of things, and also staff capacity and correct incentive system. So some kind of a framework need to be in place. So probably in place in Cambodia within a financial institution. So the second question actually is not a difficult one. So the hacker risk, this is a technology risk, is an IT risk. So and the consumers normally always have limited understanding about IT technology. This is not only in Cambodia, in any other country is the same. Even in developed country is more or less the same. So what normally need to happen is that from the regulators side, they need to have a specific regulation on technology risk management. And if my memory is correct, I think MBC already have one, which is good. And then after this guideline or regulation, then the regulator will need to do field examination, field inspection on IT risk, technology risk from time to time. And then if there is any violation, there has to be sanctions on those institutions. And inside the bank, similarly, you will also need to have a framework to manage such a risk. In other countries, there are a range of guidelines, standards, practice guides, etc. on technology risk management. We are not talking about one, we are talking about 20, 30, or even more of that. So this is a very technical area. And typically, regulator also will need you to give a certification on cyber security risk. So these levels are typically 4. So you have level 1, level 2, level 3, level 4. For financial institution, typically the minimum level must be level 3. And this certification is from CERTIS. So if you don't have that, you will not even be allowed to operate. And then inside the financial institution, under your framework, let's remember that your internal audit department will need to audit on IT risk from time to time. My guess is that most of the Cambodian institution has not yet done it, which is not surprising. But in future, I mean, need to have proper framework, including your internal audit, apart from the regulators' field inspections. And then, of course, there is also an aspect of financial education. So consumers need to know how to handle things, how to control risk under the mobile phone context, under the internet context, and etc. But this is a topic that is evolving. So in future, I mean, probably we can develop some education on this topic. There is one aspect that let me just comment informally a little bit. So there are some cases in Cambodia in the past 1 year, right? So we know exactly what you are asking for. And to be honest, normally those kind of things should not really happen. So unfortunately it happened. So, but why it normally doesn't happen, except if it is a very smart scan scheme, under the scan scheme, it can happen. So, but under the regular things, it normally will not happen. So, suppose my account, let's say, is in the US or in China. Will anybody move away $200,000 or $500,000? No way. No way. Why no way? Because there are multiple controls. Even if I lost all my technology device, it's not likely to happen. So depending on the practice of the country. In the US, they will call me if there's any money moving out beyond something like I think $3,000 or $4,000, they will immediately call me. And nowadays, since 2-3 years ago, there is a voice recognition. So when they call me at the back end, their IT system will recognize this is my voice. And before that, they will ask me like 5 to 10 questions to verify that it's really Mr. Lai. So they will ask me what's the name of my wife, and that was my last transaction and things like that. Until you verify that it's really me, and then verify that I really want to transfer this amount of money. And typically, because it is so strict, when I really want to pay a large sum, I will need to write ahead to my bank saying that I had such and such a thing. I now need to pay, let's say, $20,000. So this is the way it works in the US. In China, the way it works is if I move away certain amount of money beyond certain things, first, the regulator has a daily limit and monthly limit. The daily limit on mobile payment, I think, is it used to be 1,000 yuan. It means a little more than $100. I think now is something like probably 5,000 yuan. It's like $750 per day, and per month is like there's a certain amount, which is, I think is 50,000 yuan, which is something like per month is something like $60,000. So, and I give you a real case how it is controlled. During the COVID times, while my relative was stuck in, she actually stuck there for 6 months. She was never able to get back to the home country. So we bought ticket for her like 4 times or 6 times. And in the first 2 times, we had big trouble to pay for the air ticket, because the air ticket was quite expensive at that time. It was something like $7,000, $8,000. We were never able to pay. Never able to pay. And then eventually, I searched around why we are not able to pay. Then we found out that it was because the financial regulator has a limit on the daily payment for digital payment. and our amount is less than $10,000. It exceeded the limit. So we had to call the airline company and call somebody to give us a special authorization and identify ourselves in order to pay simply an air ticket. So this is a real case that happened to me personally. So there are many controls. And then within the institution that you hold the money, when there's some amount of money that need to be paid out, they will send me immediately on mobile phone saying that there is such and such a payment. If it's not you, please call us. But if it's my mobile phone, which is stolen, if it's really a large sum, they may hold it a little bit. So until they reach me. But typically a consumer, if they lost a mobile phone, they will immediately tell the bank that I lost my mobile phone, please close everything. But if they don't know, then that's a financial consumer education problem. So you can see that there are so many control from regulator, so many control from the financial institution. So if it's a real scam, it can happen. Because scanners, they have research department. Those people are very smart. So the research department of the scanner, so they will develop all kinds of solutions for scan, and they will write it out, they will print it out, and put it on the table of each of the hotline receiver. So when they call Jim, they will say, oh, I'm from the police department, you are in big trouble, I need to check your account, and things like that. So they will have a script, like an acting script, that they will say, and then Jim will believe it, and then Jim will do something on Jim's mobile phone, and the money will move away. But in some countries now, the police department can actually monitor. So the police can stop it immediately on the internet until they find out what's the real situation. So you see so many control in place. I have a big payment, I'm very, very nervous because I may not be able to pay for a long time until I clarify the situation to the financial institution. So I will pause here. I think you understand what I'm talking about.
Hello.
Hello.
Yes. Any more questions? You are welcome to speak out on question, not just writing. You can write or speak. So, Huyan, did we open the microphone for people?
Yes, I think that the people can open their microphone. So if the people want to speak out, so they just turn on the microphone from their end.
So this webinar means training, right? So we are not going to debate, but we already say many things. I think some of the participants, you already learned something. So when you go back, some of the things I think it will be done in your bank or in your microfinance institution is not difficult.
Yeah, I think that we still have time for 2 more questions. Mr. Koi, do you want to
Yes.
chip in? Yes, thank you.
No, I think no more question. I didn't see anyone raise. So if no more further question, I think actually we still like open. If any more query or question, the participant can reach to us and then we can communicate. As we had mentioned earlier, it is like a kind of like series webinar for our members.
Okay. So Mr. Han or Abi, do you want to say something for the closing? If not, then I will say something to close. But over to you first.
Yeah, Bang Tini, I think we would like to invite you to have a few words for acknowledgement and thanks to our speaker, partner and also participant. The floor is yours.
Okay, thank you.
Thank you. So
Thank you very much.
thank you ABC. So for your great yeah.
Miss Abby want to chip in, so could you please wait for
Yeah,
No,
sure.
it's
Of course,
okay.
that's good.
It's okay. Just a very quick word. Thank you very much, Mr. J Lai from IFC and Huyen Thi, what's her name already? The full Huyen Thi Thanh Pham from World Bank. Nice to meet you again. And Mr. James Callan for waking up very early from Ireland. And it's very comprehensive, very useful for me to understand, especially on this conduct, which is more on the applies to the staff of banks, including management and the board. And you are right, Mr. Lai, because we are very much focused on financial education and consumer protection, but ours is more targeting the consumer. And this conduct is more on who we are from the supplier side. And also about the scam that I've listened to, it's maybe not really in this conduct, but more on security and again, financial education on telling the consumer on how they can protect themselves and contact the bank. And one of the most important thing, I think that despite having this framework on integrity and honesty, there is another thing is building capabilities of our banking staff to understand what really misconduct is. And I think this one shall come from the regulator on how we deal with people, the fraudsters in our banking sector, financial sector, and that shall come after. Thank you very much.
And thank you, Abi. Thank you, ABC. Thank you, all the participants, for your active participation. I'm very impressed with all the questions that you asked. I can see that those are questions that are right in the context of Cambodia and you need solutions. Hopefully you get something today. So as mentioned in the beginning, we will have a series of webinars, technology events for the next few years. So basically, every now and then we will have some webinar. So our next webinar will be in the last few days of June. It will focus on financial ombudsman. So this word may be new to most people. An ombudsman is simply a neutral person, a neutral agency that will examine the case and then decide. And once this is decided, both parties have to implement, so that both parties feel comfortable that this is a neutral, no conflict of interest person, and it will be a fair decision. So there are internal ombudsman, like in our organization, we are internal ombudsman. So if Huyan is not happy with me, and if Huyan does not want to argue with me, he will go to an ombudsman. Ombudsman will find out the situation and then decide on something. But most importantly, external ombudsman is very useful for the financial sector. And nowadays in most countries, they already have external financial ombudsman. So this is something that the ABC can set up within a few years. So we want to first start giving the basic knowledge to everyone, so that at least people understand the English word financial ombudsman. In the Cambodian, the Khmer language, you don't have to say that. You can simply say Financial Dispute Resolution Center, which is a simple language without saying the word ombudsman, which is difficult to understand. So this will be the next webinar, and hope all of you will come back again and understand what it is. This concerns every people, every institution in the financial industry, and also regulator, obviously. So such as a scheme will need regulator to support and supervise. So I will pause here, and then thank you again. So we will close today's webinar. Thank you.